The Iran war has killed 10 seafarers, trapped 20,000 on stranded ships, pushed oil to $108 a barrel, and sent food prices surging across 3 continents. But while the world watches the chaos, one country has quietly positioned itself to profit from every single side of this conflict. That country is China. And today, we are going to show you exactly how. Welcome to EconoVault, where we unlock the world's biggest economic secrets. Today, we break down China's extraordinary double game in the Iran war, what it is buying, what still is selling, what it is watching, and what it all means for the global economy and your money. Let us start with the data, because the numbers tell the real story. China is Iran's single largest trading partner. Before the war, China was buying the majority of all Iranian oil exports at heavily discounted prices, sometimes 30 to 40% below market rate. At the same time, China's exports to the Middle East, cars to the UAE, steel to Saudi Arabia, exceeded $120 billion in 2025. In the first 2 months of 2026, China's exports to the UAE and Saudi Arabia alone grew 23%. Let that sink in. In the same months that Iran was eyeing heavy missiles at UAE cities, China's trade with the UAE grew by 23%. China is simultaneously the economic lifeline of Iran and the biggest trading partner of the countries Iran is bombing. This is not an accident. This is a strategy. Now let us break down exactly how China keeps Iran's economy alive. The mechanism is elegant and largely invisible to Western regulators. Iranian oil is shipped to China, Tehran's biggest customer, and in return, state-backed Chinese companies build infrastructure in Iran. It is a barter-like system that has deepened economic ties between the 2 U.S. rivals in defiance of Washington's efforts to isolate Iran. No dollars change hands, no wire transfers for American authorities to track. Oil flows east to China. Roads, railways, and factories flow back west to Iran. The key players in this system are China's independent oil refineries, known as teapot refineries. They play a key role in increasing China's oil supplies by importing and stockpiling discounted Iranian and Russian oil, while allowing state-owned enterprises to remain more insulated from politically risky oil trading. One of China's largest teapot refineries, Hengli Petrochemical, was sanctioned by the U.S. Treasury just last week. The Treasury said it is one of Tehran's most valued customers and has generated hundreds of millions of dollars for Iran's military. Washington has seen enough, and it is striking back hard. The U.S. Treasury Department imposed sweeping sanctions on shipping firms, vessels, and a Chinese oil refinery in a widening crackdown on maritime business with the Iranian regime. Treasury Secretary Scott Bessent pledged to continue targeting the network of vessels, intermediaries, and buyers Iran relies on to move its oil to global markets. The warning was clear. Any person or vessel facilitating these flows through covert trade and finance risks exposure to U.S. sanctions. And today, May 4, 2026, the United States formally warned China that its purchases of Iranian oil amount to funding global terrorism. That message came directly ahead of a Trump-Xi summit in Beijing. China's response was immediate. The Chinese embassy said America should stop politicizing trade and stop using sanctions as a weapon against Chinese companies. The confrontation between Washington and Beijing over Iran's oil is now out in the open. But here's where China's strategy becomes truly remarkable. At the exact same time China is keeping Iran economically alive, it is selling billions of dollars worth of goods to Actiga, the Gulf states that Iran is actively attacking. Saudi Arabia is buying Chinese steel and construction materials. The UAE is buying Chinese electric vehicles and technology. Qatar is buying Chinese infrastructure services. The Iran war has delivered a profound and systemic shock to the Gulf, fundamentally challenging the region's security architecture. That security architecture rested on a traditional oil for security arrangement, maintained by a dense network of American military bases. As Gulf states lose faith in American protection, they are turning east to China for trade, for investment, for technology. China continues to import a major share of its crude oil from the Middle East, including Saudi Arabia and the UAE. The Gulf states now view China not as the new America, but as a necessary hedge. China is not replacing America in the Gulf, but it is filling every gap America leaves behind. Now we need to talk about something that goes beyond economics. Because China's real prize from this war may not be oil or trade contracts. It may be military intelligence. A protracted military conflict in Iran diverts U.S. military resources away from the Indo-Pacific, with potentially major consequences for the future of Taiwan and the South China Sea. Observing U.S. naval operations in real time in the Gulf could also prove very valuable for China if tensions in the Strait of Taiwan were to flare up. Think about what Beijing is watching right now. Every U.S. carrier strike group deployment, every missile defense pattern, every naval blockade tactic, every drone and helicopter operation. The United States is conducting the most sophisticated real-world naval pressure warfare in decades, and China has a front-row seat. Whatever happens next in the Taiwan Strait, China will be better prepared because of what it learned watching the U.S. military fight in the Persian Gulf. Now, to be fair, this is not a cost-free strategy for Beijing. China is also absorbing serious economic damage from this war. China sources about half of its crude Tanaka Kamya and around 30% of its LNG from suppliers in the Gulf, including Saudi Arabia, Iraq, the UAE, and Qatar. A sustained closure of the Persian Gulf risks shortages, skyrocketing freight and insurance costs, and fierce competition for rerouted cargoes. China saw this coming. In the first 2 months of 2026, Chinese oil imports surged 16% for stockpiling, building strategic and commercial reserves covering about 4 months of imports. 4 months. That is China's buffer. If the strait stays closed beyond that, Beijing faces its own energy emergency. And the U.S. sanctions campaign against Chinese refineries is starting to create real pressure. Teapot refineries are facing high replacement costs as their access to discounted Iranian oil gets squeezed. China is winning this game for now. But the longer the war lasts, the more it costs Beijing too. So where does China's double game end? 3 scenarios. Scenario 1. The war ends within weeks. Project Freedom reopens the strait. Iran accepts a deal. China emerges having bought the cheap oil throughout the conflict, strengthened Gulf trade ties, collected military intelligence, and paid no political price whatsoever. This is China's best outcome. Scenario 2. The war drags through summer. U.S. sanctions escalate against Chinese firms. The Trump-Xi summit in Beijing becomes a direct confrontation over China's continued support for Iran's economy. Beijing is forced to publicly reduce Iranian oil purchases in exchange for relief on other trade tensions. China wins less, but still wins more than it loses. Scenario 3. The conflict spreads. China judges that U.S. military resources are sufficiently stretched. Tensions in the South China Sea or Taiwan Strait escalate. The world faces a two-front geopolitical dismal. This is the low-probability, catastrophic scenario that Western defense planners are stress-testing right now. Most analysts believe scenario 1 or 2 is most likely, but the direction of the Trump-Xi summit in the coming weeks will tell us which path we are on. So what does China's double game mean for you? If you are a consumer, China's continued purchase of Iranian oil is directly prolonging the energy crisis. Every barrel China buys from Iran is a barrel that keeps the economic pressure on Iran lower, which means Iran has less reason to reopen the strait. That means higher fuel and food prices for longer. If you are an investor, the Trump-Xi summit is the most important market event of the next 30 days. If America puts real sanctions pressure on China over Iranian oil, Chinese manufacturing and technology stocks face significant downside risk. If a deal is struck, markets will rally sharply. If you are watching the big picture, the post-war world will have China more deeply embedded in Middle Eastern trade and politics than at any point in history. That is a fundamental shift in global power that will play out across decades, not just months. China did not start this war. China has not fired a single shot, but through careful, calculated economic maneuvering, Beijing has turned the worst geopolitical crisis of 2026 into a strategic opportunity. Buying from the sanctioned, selling to their enemies, watching, learning, positioning. Whether that strategy ultimately succeeds depends on how long this war lasts and how hard America is willing to push back. EconoVault will keep tracking every development. If you found this breakdown valuable, hit the like button, subscribe for weekly breakdowns on geopolitics, economics, and finance, and drop a comment below. Do you think China is playing this strategically, or will it eventually pay a price for backing both sides? See you in the next video.